indicators. Over the years, analysts have watched a number of developments in the society around them in an attempt to gauge the overall mood, emotion, and sentiment of market participants. Many of these indicators are qualitative and not quantitative. Although these indicators are not easily quantifiable and do not lend themselves to traditional statistical testing, they still provide important information to technical analysts. Eccentric sentiment indicators. Over the years, stock market followers have developed a number of eccentric indicators to predict stock market movements, not based on economic or financial data. These indicators are feel good or hype in indicators that attempt to measure the overall moral of the investing population. One of the oldest feel good indicators, first suggested by either the late Ralph Rotem of Harris, was hemlines rose. So did the stock market, and the hemlines fell. So did historical indicators. There are several indicators that technical analysts have used historically that you may see discussed in literature. Although these indicators have little relevance today, at one time they played a prominent historical role in measurement of market sentiment. The first was NYC member and non-member statistics indicator. The second historically important sentiment indicator to have fallen from favor is Barron's Confidence Index. This index, developed in 1932, measures the ratio of yields on high grade bonds versus yields on speculative bonds. Although it is still published today, it seems no longer to have relevance for measuring stock market sentiment. Insiders, the ultimate informed player, at least in individual stocks or commodities, is the insider. An insider is anyone who is knowledgeable member of firm that either trades in the commodity underlying the future most important to firm's business, such as oil to an oil company or cocoa to a candy company, or who has knowledge of company's internal business prospects and result and is a stockholder. So basically insider trader is a trader who has internal informations about that company. The trading positions are divided into two major categories, commercial and non-commercial. This nomenclature is an outgrowth of agricultural origins of the reports. In the financial markets, commercial traders, individual or institutional, are those who operate in the cash market and thus called hedgers. The non-commercial participants take speculative positions, change positions more frequently, and are called large speculators. Traditionally and empirically, in the stock market, the large speculators have a better record of anticipating market moves, whereas hedgers tend to lag behind and follow the trend.